welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest, Robert Green from Green Tax. Before we get started, just a quick disclaimer. It won't be the usual one because we're not talking about any trades per se, but Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We're not making any specific trade recommendations. So we'll leave it with that. The full disclaimer is on the recording at the start of each video. And just remember, it is for educational purposes only. So with that, Robert, welcome. Like we were talking about earlier, I was introduced to you a few years ago when I was working at Sheridan Mentoring, so it's nice to contact you here and have you present to Capital Discussions in our group.
Thank you, Tom. It's nice to be here. I'm a CPA, which in the U.S. is a certified public accountant. Tax compliance in the U.S. is very complex. You American people on the call know that. Some of the non-resident aliens of the U.S. Probably know it as well. I've been doing this a long time. We're the leader in the trader tax space. We have clients throughout the U.S., Americans living worldwide, and we also advise a lot of non-resident aliens with U.S. brokerage accounts making investments in the U.S. I've written the books on this subject, been in all the leading media, and you can see more on my bio page. Now, this session is educational. It's not one-on-one tax advice. I'll try to answer some of your questions today in a general way. I encourage you to consider a consultation with me, which is one-on-one paid tax advice. If you, by the way, and I'm not an attorney, so if we talk about any concepts that seem legal-oriented to you, CPAs do talk about tax law, but I'm not an attorney, and I'm not an investment advisor. We don't give investment advice. It's a good place to start on our website, Green Tax. And we have a Trader Tax Center where we have a lot of information on different subjects. And we're going to go through that today rather than a PowerPoint presentation. This is all newly updated. We just published the Trader Tax Guide. So if you click over here, Trader Tax Guide, this guide is now out. And you can click on an excerpt and see all the endorsements. This is really what most people need. There's a whole chapter on international tax matters. All the other chapters are for Americans on the tax issues. The Trader Tax Center is sort of excerpts of that guide. And then we have an area of professional services. Tax compliance is our core business. We prepare tax returns for traders. Consultations is really the first way that people start working with us usually. They read the guide, and then they have questions that they want to discuss with me. Next, we may form an entity, and I usually handle that again myself. Form the entity like a single member LLC S Corp, or an entity for international people trading in the U.S. We can help you with accounting, especially if you're trading securities, where the trade accounting is very detailed, line by line, wash sale reporting, cost basis, a lot of issues, mark-to-market accounting if you elect it. Now, if you run into trouble with the IRS, we have a representation service. And we also have a significant investment management practice area where if you set up a hedge fund or you do separately managed accounts. And we have attorneys that work with us as well. You can learn more about us. We're virtual, work out of the cloud, all best practices. We have a great roster of CPAs. My partners, Darren Neuschwander, Adam Manning. We have wonderful tax attorneys and great CPAs, great people. And you can see that we dominate the media, the testimonials, videos. We're really the place to go for tax. So let's start with first page of the Trader Tax Center, the different types of traders. A casual investor may trade a lot, but they don't trade enough for trader tax status business treatment. They have a lot of trades with a lot of tax treatment issues, wash sales, investment expense treatment. It's still pretty complicated on your tax return. If you trade futures, it's less complicated than securities. Now, the active trader, they get real close to trader tax status, business treatment, but they fall a little short. And we're going to talk about how to qualify. Now, this is for the American taxpayers. This is for American citizens, green card holders, and people living in the U.S. meeting the substantial presence test. So if you are a citizen or a green card holder and you're living in Germany, like Tom. You're still a U.S. resident. You're a legal resident. Otherwise, if you don't have legal status, you're not a citizen, you don't have a green card, which is a permanent resident card. They call it a green card. I guess it used to be green. If you don't have that legal status, if you meet the substantial presence test living in the U.S., counting up the days is a very detailed test, then you file as a resident. So for U.S. residents abroad, U.S. residents in the U.S., what I'm talking about now rings true. It really matters. Now, this is the golden goose of our content, the business trader. This is a small minority of online traders qualify for trader tax status. They should master the content in our guide. There's a full array of benefits. We're going to go through how to qualify. It's basically 60 trades a month, 3 to 4, closer to 4 days a week, holding periods well under 31 days, 4 hours a day or more, serious account size, serious tools, and intention to run it as a business. If you meet those tests, you have all these business deductions, including for education and chat rooms, and all your powerful computers and monitors and home office, and seminars and travel. If you're not a business trader, if you're an active investor or a casual investor, you still may trade every single day. But if you don't trade with enough volume and frequency, you're stuck with a default investment expense treatment. That's like a miscellaneous itemized deduction, doesn't include home office, doesn't include startup costs, doesn't include education. You wind up with very few deductions, and you're stuck with wash sales on securities. You can't elect mark-to-market accounting to get out of wash sale treatment. You're stuck with a capital loss limitation. It's not the best situation, but being a business trader is. Now, a patent day trader, that's a credit thing. That just means you have 4-to-1 leverage because you have $25,000 in an account. Some people try to skirt that by going to, let's say, an offshore account, but that could be problematic. Now, a proprietary trader is a little different. A proprietary trader is trading the firm's capital. You're joining a prop trading firm, and they're engaging you as an independent contractor or an employee or a member of their LLC, and you're trading the firm's capital. You may have to put up a deposit. So we show you how you can write off a lost deposit. We show you how you can write off expenses. But you don't have trader tax status. The firm has it. If you're an LLC member, you get a K-1. I don't know if we have any prop traders on the call. As we go through here, content, what I'd like you to do is in the chat area, you don't have to ask a full question, although you may. Keep them brief and general. But you can also say, talk more about a topic that I just mentioned, like proprietary trading. Now, investment management, again, that's another different area. That's when you trade other people's money, investors. There's a lot of red tape on that. So there's separately managed accounts and hedge funds, onshore hedge funds, offshore hedge funds. And throughout our site, there's a lot more information on the different types of traders. So again, there's all these different types, plus they're either American taxpayers or they're non-resident aliens. So far, Tom, what are you seeing on the board about who's here? What kind of traders do we have so far here today? Let me open chat as well.
They're not professionals by that definition because option traders, we're generally taking longer-term positions. So we're not like, day traders of stocks where we're in and out all the time. So
right. Now, when it comes to options traders, some of them do qualify for trader tax status, but it is a much greater challenge to qualify if you trade the monthly options rather than the weeklies, and you bunch trades around expiration. You're not going to reach trader tax status unless you take some of your capital and do day and swing trading in perhaps in equities, besides just equity options. So equity, people who trade options may not qualify for trader tax status. They're stuck with investment expense treatment, wash sale loss adjustments, and what they don't realize is that they have to calculate wash sales between the underlying equity, the option on that equity, and the option on that equity at different expiration dates. Brokers don't report that on a 1099-B. Brokers use identical positions only, which is the exact symbol. But substantially identical positions is what taxpayers need to comply with in Section 1091 wash sale rules. So this is a typical example. You go to our Trader Tax Center, go to tax treatment. And there's two areas in tax treatment here. On the right side here, explore. You have options and you have wash sales. So we would go to options to talk about how options are taxed. And again, there's a lot more information in the guide. So an interesting thing about simple versus complex options. When you deal with outrights, it's like buying and selling any security. But when you have complex trades, which include your option spreads, the multi-legged offsetting positions like the iron condors, the butterflies, the verticals, all that, there may be straddles and offsetting positions that you have to deal with. And even the software that we advocate, TradeLog, which is great on the wash sales for substantial identical positions, it doesn't make automatically the offsetting position adjustments. Now, in the guide and the chapter on trader tax status, we explain how it's a lot harder for an options trader to qualify for the business expense treatment. And remember, with trader tax status, which is the business treatment, it unlocks a whole assortment of the benefits. It gives you the business expenses, the first area, the right to elect 475, tax loss insurance. Now, what's so good about 475 is it exempts you from wash sales, and it exempts you from those offsetting positions on the complex trades because you're marking everything to market. So actually, if you're an active options trader and you have complex trades and a lot of wash sale issues, and you're real close to qualifying for trader tax status, if you could just take some of your capital, maybe like 5 or 10% of it, and actively trade equities or weekly equity options so that you do qualify for trader tax status, and then you can elect 475, you'd be much better off. And plus you'll have the tax loss insurance of 475, which means you're exempt from the capital loss limitation. If you lose $25,000, you can write off the whole thing as a business loss against any type of income. Otherwise, with the default capital loss treatment, you're only allowed to deduct $3,000 a year against other income. Tom, back to you. Tell me a little bit more about what the participants are, what kind of traders they are, and what kind of questions they have.
Well,
so I see one question here, by the way. Let me jump in from Andrew. Do you avoid a lot of these issues by trading 1256? You know, I just wrote a blog post today, which is kind of a scathing piece about brokers who I feel are concealing this wash sale loss problem. And I'm telling active options traders to consider 1256, equity options traders to consider 1256 options, because then you don't have to worry about offsetting positions and wash sales. And I think that's why your securities brokers don't like to advertise this problem that I talk about in a very specific manner. They don't want to advertise it because I think they're afraid they'll lose clients who will move over to trading 1256 contracts, which, by the way, also have lower 60-40 tax rates. 60% is a long-term capital gain, even on a day trade. So the tax rates could be 12% lower at the top brackets and meaningfully lower throughout the brackets. Because remember, at the lowest brackets, at the 10 and 15% brackets, the long-term rate is 0. So 60% is taxed at 0. So yes, that is a solution. Back to you, Tom.
Well, most of our traders, I would say, are trading the index options and or some futures options, a smaller percentage. But the vast majority, like Russell and SPX index options, is what they're trading.
Well, that's great, because let's go back over to tax treatment now and go to Section 1256 contracts. Remember, this is just a brief excerpt from the guide. You all really should get the guide. And by the way, there's a promotion on it, 20% off through January 15th, so you can still capture that. So I would get the guide tonight.
How much is the guide, just out of curiosity?
So you would just click on the guide page, and it's about $42 with a discount. You click purchase, and you would get the download for $42.36, or the paperback and the download for $47.96. The list price is $59.95, so it's 20% off. It's going to save you a lot of money, the guide. You definitely should get it. So let's go back to the tax center. So the 1256 contracts, they include the U.S. futures, regulated futures contracts, and options on futures. Foreign futures with a CFTC and IRS approval letter, like the French exchange was advertising that they had 60/40 treatment, 1256 treatment on their contracts. I think that New Edge, the broker, big French broker, I believe their name was New Edge. I had to correct them. They did not have 60/40. They had CFTC approval to market to Americans, but they didn't have IRS approval, which is a letter ruling saying that they could use 1256 treatment. Only about 6 or 7 exchanges do. You read about that in the guide, and there are blog posts that get into this in detail as well. Broad-based indexes and options on broad-based indexes are 1256. If it's a narrow-based index or an option on a narrow-based index with 9 or more securities, it's a security, not a 1256. Forex forwards, and I make a case for spot 2, can go into 1256G if you make an election. Options on commodities ETFs and other non-equity options. Always make sure you're in that club for 1256. So options on futures, options on broad-based indexes, that's all 1256. So you get those meaningful lower rates and mark-to-market and don't have to worry about the wash sales and don't have that problem with the complex trades. Hey, that's great, the lower tax rates. Unfortunately, if you don't trade enough, you're going to have investment expense treatment. Now, let's talk about that, how that works. Let's go back to the trader tax status area and look at the business expense area. Now, unlike business traders, investors are stuck with restricted itemized deductions. Investors can't deduct pre-business education, most seminars and travel, home office, and startup costs. Investment expenses are only allowed as part of miscellaneous itemized deductions in excess of 2% of adjusted gross income, and they aren't deducted against the AMT. So if you're making a decent amount of money, I mean a couple $100,000, well, that's a good amount of money, and you may have alternative minimum tax where you don't get the deduction at all. It's a preference. If you make a lot of money, there's a piece itemized deduction limitation which wipes a lot away. So a lot of this ends up on the cutting room floor. But if you're using a lot of broker tools and online free services, you may not have a lot of expenses. Now, if you're trading full-time and trading a lot, and you have a full home office, 4 or 6 monitors, several powerful trading computers, a lot of equipment, education, all sorts of expenses, you'd rather have the trader tax status and save on average of about $5,000 a year. Because your business expenses include 100% depreciation, amortization on startup, expensing. You buy something for under $2,500, you can expense it. You don't even have to depreciate it. Education after you start your trader tax status. Books, publications, market data, professional services, chat rooms, mentors, coaches, supplies, the works, home office. It's really a nice thing to have those business deductions. But if it's not in the cards for you, so you won't save that extra $5,000 or $10,000 a year. It's more important to make good money and use that 60/40 treatment. Now, if you don't have trader tax status, you don't need an entity. And you can't have the employee benefit plan deductions. Because that goes with the trader tax status. That's why employee benefit plan deductions is part of trader tax status. An investment company cannot do health insurance and retirement plan deductions. You need trader tax status. And then you would set up an S-Corp trading company or an S-Corp or C-Corp management company in association with a trading LLC or partnership. Probably just need that S-Corp. But if you're in certain jurisdictions like New York City or California, in California if you're making a lot of money, where the S-Corp has a franchise tax, in New York City they don't acknowledge the S-Corp, so you might need a dual entity, a trading general partnership, and then the management company to do the employee benefits. You need the S-Corp or the C-Corp management company to have payroll and deduct health insurance and have a high deductible retirement plan. which can be really fantastic. You'd come over to the Retirement Solutions page. You'll pay the salary, which creates the earned income that you need, because trading gains are not earned income. You're creating it with the S-Corp wages or the C-Corp wages. And then you have this solo 401k retirement plan. You can contribute $53,000 to $59,000 a year. You start off with the $18,000 elected deferral. That's 100% deductible, because the plan includes that 100% deductible elective deferral plus the 25% deductible profit sharing plan. If you're age 50 or over, there's a catch-up provision of $6,000 more. That's a great retirement plan deduction. The solo 401k, you'd have it on the S-Corp entity level in relation to the payroll. Now, if you're 50 or older, making some big income, whoops, sorry about that. Let me get that back. Then you want to consider a defined benefit plan. Wow, you can contribute well over $100,000 a year. It's incredible, the savings you can have. But you need trader tax status as the key to that. Let's see, Shakri has a question here. If I have an IT company, can I open an investment account in the IT company and take advantage of trader tax status? No, but let me tell you more about it, which we cover in full in the guide. We never recommend using a C-Corp for a trading company, because there's double taxation, no 60/40, and there's no investment expenses allowed in a C-Corp. Now, if you happen to have an auto dealership or an IT company that's a C-Corp, and it's got a significant ongoing business, and you invest some of the treasury capital, that's really considered a business expense, not an investment expense, because investing the treasury capital is ancillary to running the business. Now, we don't think you should run trader tax status through a pass-through company, because the IRS, it will confuse the IRS. They'll see that you're an IT company and won't respect trader tax status, so we generally recommend separation. These are some very nuanced points, and I cover them in full in Chapter 7 of the guide. There's an extensive chapter on entities, and we cover those issues. And you said the IT company is an S-Corp. So if you had an IT company S-Corp making $100,000 from IT, and then you added another $100,000 from trading, it's going to put a lot of pressure on you for more reasonable compensation from the IRS, when in fact you'd rather just take the $100,000 S-Corp income, pay reasonable compensation at 25%, $25,000, and save the entire 15.3% FICA on the other $75,000, because it's under the Social Security base. So remember, with a regular operating business S-Corp that has underlying earned income, you have to have reasonable compensation. And the S-Corp tax break helps you reduce payroll taxes or SE self-employment taxes, the FICA and Medicare. Because if you operate through an LLC partnership return, it all is self-employment income. I cover that whole strategy in Chapter 14 of the guide. I really hope a lot of you go out and get the guide tonight, because you can really benefit from it. It'd be nice to see. Okay. And good, Shakri, I see you got the guide, so read it through, and you probably have already done your homework on that. So, Tom, did you want to jump in with a little bit more feedback from the participants or suggestions here?
Well, I don't see any more questions.
I know we have a lot of international traders, so what we talked about so far was trader tax status and tax treatment. You know, the big thing with tax treatment is securities have WAR sales, but 1256 contracts don't. Options cover the gamut. Some are 1256, some aren't. So you can go back and look at your tax treatment. There's Forex in here and other, Bitcoin, Nadex, all sorts of stuff. Tax treatment has to do with what you're trading. Trader tax status has to do with the business treatment. Accounting, I talk a lot about the securities with the WAR sales. Tax forms and compliance are kind of like what forms you're using. The entity, what's the best entity strategy that's really for your business trader. The retirement solutions go hand in hand with the business. Now, tax planning, a lot of that has to do with going into year end, and we just did that, but the year has passed, so that's now not topical. Let's take a look at this in international tax matters in detail, because I know, Tom, you have a lot of international members who live abroad. So when we talk about international tax members, we talk about U.S. traders who move abroad, but they're still U.S. taxpayers, others who make international investments from while they live in the U.S. And non-resident aliens means people who don't live in the U.S. and don't have legal status in the U.S. who invest in the U.S. and how they're all taxed. So we focus on the U.S. residents living abroad, U.S. residents with the international investments, U.S. residents who move to tax possessions like Puerto Rico, which has great tax benefits for traders now. Basically, you can be tax-free on capital gains and dividends. Not dividends on U.S. companies, but dividends from, if you have, let's say, an investment management firm operated out of Puerto Rico. U.S. residents moving abroad who surrender their citizenship or green cards. That's happening more and more frequently as well. Still a drop in the bucket, but it's happening more and more. It's increased quite a bit each year. Non-resident aliens investing in the U.S. A lot of times people living in a foreign country want to trade with a U.S. broker, and the broker may say, you know something? I really don't want to open an account for you here in the U.S. where I can't. Why don't you just open up a U.S. entity like an LLC in Delaware and then have that entity open the account? How is that all going to work out for you? Is that going to trigger taxation in the U.S.? So let's start with U.S. residents living abroad. U.S. tax residents are liable for federal tax on worldwide income, whether they live in the U.S. or a foreign country. The U.S. is not like most foreign countries like Germany that have better non-territorial systems. They basically say you move abroad, we're only going to tax you on your country income in Germany. If you work in London, we're not going to tax you on that income. The U.S. is sort of a tax imperialist in a sense. They want to get you on your worldwide income. And a lot of Americans live all around the world. The U.S. does give some tax equalization benefits to its residents abroad, like the Section 911 exclusion on foreign earned income, $100,800 for 2015 and $101,300 for 2016, and a housing allowance, both reported on Form 2555. So that's foreign earned income. Let's say you move to a country that does not tax you at all, a tax haven country. So you're not going to get a foreign tax credit. And it's nice that the first, in 2016, $101,300 is going to be tax-free in the U.S. if you file Form 2555 in a compliant manner. You have to be a bona fide resident abroad or under the physical presence test. And so you really have to live abroad for a year. And it's got to be foreign earned income. Trading gains are not foreign earned income. So the first order of business for our clients is if they're a business trader, we can use entity solutions to pay compensation, which is deemed foreign earned income. Now, there's a plethora of other international tax issues to consider, like income tax treaty with the U.S., establishing bona fide or physical residence, foreign tax credit. So if you don't get the foreign income exclusion and you're in a foreign country and you pay taxes, you're not supposed to pay taxes twice. You get a foreign tax credit. Are you paying the equivalent of Social Security in a foreign country? If you are, you can be exempt from that in the U.S. It has to really be a separate FICA tax, Social Security tax treaty. It's pretty complex. But we have a lot of U.S. residents abroad, a lot of traders living in London, Singapore, Hong Kong. There are foreign countries that don't tax your capital gains. I believe in Singapore or Hong Kong, one or both. So I'm not sure about that. I'd have to double check my file. But in any event, there are a lot of benefits and a lot of pitfalls. Setting up offshore companies can be a lot of red tape. They're not really going to help you, but we'll get into that next. Now, there are also U.S. residents that have international investments. They're sitting in Connecticut, like I am today. And they, through their brokerage account, they have access to all these foreign markets, or they go ahead and open up an account in a foreign country. So they're a U.S. resident living in the U.S., but they've made investments abroad. Now, they have offshore trading and bank accounts. Some offshore brokers encourage traders to form foreign entities as a requirement to get access or to set up an account. The FATCA regulations have kicked in, Foreign Account Taxpayer Compliance Act, and the U.S. government is forcing, Treasury is forcing foreign banks to report information on Americans, sort of like 1099-Bs, and so that people can't hide offshore, hide accounts, and hide income. A lot of foreign banks are saying, this is just way too much red tape. I'm just not going to deal with Americans. So they tell you, listen, why don't you set up an offshore company and I'll deal with the offshore company. Well, that doesn't really skirt the rules. And it's not going to give you any tax deferral. It's going to be a PIFIC, passive foreign investment company, or a controlled foreign corporation. There's going to be really no deferral to speak of, because there are PIFIC rules to pick up the income so you don't defer it. And there's a lot of red tape. Your tax return is going to look like Mitt Romney's return. You remember years ago when he ran for president, they showed he had 500-page tax return, like 400 pages of all the international stuff and PIFIC. It's a lot. You're going to pay accountants a lot of money and not get any tax breaks, and maybe cause yourself to get audited. So if you do have a foreign company, which can make sense, try to keep it simple. It might be a disregarded entity for U.S. purposes, and not even treated as a separate entity. Now, don't forget, you got to report your foreign bank accounts. U.S. residents, foreign bank, brokerage, investment, and other types of accounts, including retirement and insurance in some cases, must be e-filed on FinCEN Form 114, Report of Foreign Bank and Financial Account. If your foreign bank and financial institution accounts combined are under $10,000 for the entire year, you fall under the threshold for filing the FBAR. If you do need to file one, they are due by June 30th of the following year. So if you had a foreign account or several accounts, including your spouse if you're filing jointly, and in total you got over $10,000 when you convert it back to dollars at any point during the year, you got to file the FBAR for all those accounts. And it's due by June 30th. There's huge penalties if you don't do it. Now,
but a quick question: balance stays below 10,000. Like, say for me, I'm paying a mortgage, so I make a deposit, the bank takes it out. Make a deposit, bank takes it out. It never goes above 10,000. But I'd be
okay.
Okay.
Yeah, you just want to make sure the balance stays under 10,000. But when in doubt, you're better off reporting, because you're picking up these accounts on your tax return anyway. So why omit them and get this $10,000 or more penalty?
Right.
Now, foreign retirement accounts. Don't assume foreign retirement plans are like U.S. retirement plans with tax deferral on income until distributions are made in retirement. So a lot of people, they might have, they're retired from IBM in France. They have a retirement plan. And for years they worked in the U.S. and they had a green card, and they want to keep the green card, but they moved back to France. And they figure, hey, it's a retirement plan. It's tax deferral. It's not, unless tax deferral is elected, arranged, and specifically provided for. Plan to pay annual taxes on the income. Whether the foreign retirement plan has deferral or not, file the annual FBAR. Now, there's a lot of Canadians living in the U.S. and Americans living in Canada. It's a huge border, and it's just a lot of that going on. And the IRS issued last year relief to Canadian retirement plans. In October of 2014, the IRS acknowledged the tax deferral problem on Canadian retirement plans, and it now provides relief. So there's a lot of Canadians who, let's say, they live in Florida now, and so they're American residents, and they figure they had tax deferral before they retired on that retirement plan. They automatically have the relief. They don't have to file the election. But otherwise, if it's France, you got to file the election. And a lot of people don't realize it's FBAR 2 reporting. Now, part of FATCA was they came out with this Form 8938, foreign assets reported on Form 8938. That's not an income tax form. That's kind of like an FBAR reporting form. Tax Form 8938, starting in 2011, is intended to give the IRS a heads up regarding your offshore assets. It's not about reporting income and loss. There are other tax forms for that. The filing threshold for Form 8938 is materially higher than the FBAR threshold, and it's even higher for Americans living out of the country. It's a detailed threshold, so in the guide I refer to it, and on the blogs I refer to it. But you can always also just Google Form 8938 and look at the instructions. Now, the IRS has an offshore voluntary disclosure program, mostly related to not filing FBAR. So consider entering the IRS Offshore Voluntary Disclosure Program, OVDP. Used to be OVDI. It was initiative, now they changed it to program. And it's been extended to encourage taxpayers to come clean before getting busted by the IRS. Now, there were deadlines on this program, but the IRS was having great success with it. So they continued it, but they continued it without saying what the deadline is. So at any day it could end. So they figured that's a great way to incentivize people to enter the program and not take it for granted that it will be available to them. In the meantime, they keep busting foreign banks one at a time. Julius Baer was the last one to settle. They went through all the Swiss banks and others, and those banks are turning over the client list. You get busted by the IRS on hiding income and accounts before you enter this program on your own or come clean on your own. There could be criminal penalties, which means you can go to jail, and there could be outrageous civil penalties, really high. I mean, they could take a lot of the money away from you. So the OVD, now keep in mind, if you enter the program, you're not really doing yourself a big favor. I mean, the penalties are still large. It's not amnesty by any means. And there are times when you should just file the FBAR late in a streamlined manner and skip this program, and you'll do better off. So it's very complex. You need to speak with a tax attorney who really knows this area, and we have one, Mark Feldman. The OVDP penalties are generally high, though there are exceptions. It's not amnesty by any means, and it's an expensive undertaking with tax attorneys and accountants. So you would hire Mark Feldman, our tax attorney, directly, his law firm directly. He would then engage us as CPAs to help on your account, so you would maintain the attorney-client privilege. And you would first go through everything with him in a consultation, not me. I'm a CPA. You'd go through with the tax attorney where you would have the attorney-client privilege. Now, if you wait to get busted by the IRS, your foreign bank, or by your foreign bank who turns you in, or anyone else under a whistleblower program, the penalties are far higher and criminal penalties are applied. It's serious stuff. Now, U.S. possessions. Puerto Rico is one of the most popular U.S. possessions. It has U.S. Virgin Islands is a possession. Samoa, Island of Samoa. Puerto Rico has enacted tax incentive acts that are tailor-made for traders, investors, investment managers, and financial institutions. Enacted in 2012, Puerto Rico Act 22 allows investors and traders with bona fide residence in Puerto Rico to exclude from Puerto Rico and U.S. taxes under Section 933 100% of all short-term and long-term capital gains from the sale of personal property accrued after moving there. So you have to move to Puerto Rico lock, stock, and barrel. You really have to live there. San Juan's nice. There's areas outside of San Juan. Services are in decline. They're facing bankruptcy, reorganization. But you can move there. You don't have to buy a home. And if things don't work out, pack up and move back to the U.S. It's great if you're a young single guy without a family and kids, because you'd otherwise have to move the whole family. You really have to move there. And then when you're buying and selling stock after you move, your tax home is in Puerto Rico, so you're taxed in Puerto Rico, not the U.S. Puerto Rico says zero tax, and the U.S. leaves you alone. Now, if you still have wages from the U.S. because you're telecommuting, a virtual job, or if you have dividends from U.S. companies or U.S. real estate, that's U.S. source income for which you still file a U.S. tax return. So you're kind of breaking up your tax return into a Puerto Rico piece and a U.S. piece. Now, if you're an investment manager, you've got to move your whole operation there. You can have an export service business that only pays a 4% tax. And then when you pay yourself dividends from that business, it's tax-free, 100% tax-free. That's a little harder to move your whole investment management business there. But for your young trader with a small investment management business, they can do it. Now, renouncing U.S. citizenship or surrendering a green card. I'm not advertising that you should do that. I'm a patriotic American. I'm not saying you should do it. You suppose Bernie Sanders gets elected and Congress goes Democrat and they raise the taxes to 75% by the time you add it all up, federal, state, and city, and you just get fed up and everything is in decline, and you just say, you know something, I can just trade from an island in the Caribbean. I can trade from Monte Carlo. I don't need this anymore. And so you want to move. Well, if you move with your citizenship, you're still taxed worldwide. That doesn't do you a lot of good. It gives you that 9/11 exclusion, but not much else. So maybe you want to renounce. So some countries, let's go through this. Some countries have much lower tax rates than the U.S., and a few countries exempt capital gains from tax. As I said, I think it was Singapore, Hong Kong. A lot of people want to go to Asia now. It's where the action is. Increasingly, traders, investment managers, and other taxpayers are surrendering their U.S. resident status, citizenship, or green card, which requires potentially paying a Section 877A expatriation tax. While the expatriation tax will certainly take a big tax bite out of the rich, it won't apply to the majority of online traders who may not have significant unrealized net gains and or may not be covered expatriates. I go through all the details in the guide, but basically there's a nice threshold. You're looking at your portfolio. Now, if you're, a rich American with, like Warren Buffett or Bill Gates, they're going to look at your whole portfolio of all the assets that you own, and everything over this threshold is going to be subject to the expatriation tax. But a lot of traders go to cash every year. They don't hold a lot of open portfolio stuff. And some of their stuff could be exempt, so they may not have this so-called unrealized capital gains. What the U.S. wants is they don't want you to build up this huge portfolio of unrealized capital gains and then think you can just surrender your green card or citizenship, green card with long-term residence, and then just get off from paying that built-up unrealized capital gain. So that's explained in the guide. Not a big deal for a lot of traders. They can do it. You may be sorry to give up that citizenship, but suppose you're a dual citizen already. You're a dual citizen of Germany and the U.S., and you say to yourself, listen, I'm happy with my EU passport and citizenship. I don't need a U.S. citizenship and passport. You may come to that conclusion. Now, this is a very interesting last item here. Well, I'm sorry, we didn't get to the last item. The next thing is non-resident aliens investing in the U.S. Let's see how we're doing on time here.
Oh, still okay.
Yeah, we're still doing good on time here. And we can go a little long, Tom, and I like the way it's going here. We'll finish this page, and we'll see where we stand. Non-resident aliens investing in the U.S. I get this a lot. There are people throughout the world that are interested in trading now. And they're interested in U.S. markets. There's great markets. There's been great volatility at times, liquidity, really cheap commissions, and it's great platforms. It's really the leader worldwide. So why not trade American markets with American brokers? Now, some people go into it with the wrong intentions. They may feel, hey, listen, I live in India, and I'm going to violate the central bank rules and on currency exports or whatever. Don't get into any of that. If we sense any of that, we're not going to work with you. I'm saying if you legally can trade your capital in the U.S. without playing any games with your home country, it's a good thing to consider. Now, non-resident aliens are subject to tax withholding in the U.S. on dividends, certain interest income, and sales of master limited partnerships like energy companies. They have U.S. source income, effectively connected ECI, on real property and regular business operations located in the U.S. A non-resident alien living abroad can open a U.S.-based Forex or futures trading account and not owe any capital gains taxes in the U.S. Now, this applies to a securities account as well, only there could be some dividend tax withholding. So you open up an account in the U.S. and you get some dividends on U.S. stocks. They're going to withhold taxes at the dividends rate, and you may be entitled to a lower rate according to a tax treaty that your country may have with the U.S. So if you're fine with them withholding dividends on dividends at the rate that they do, and you don't want to get a tax refund, you don't have to file a 1040 non-resident NR tax return. You can just let it be. Don't file anything. But if you want to get a refund, you would file the 1040 NR return. And you can hire us or some other accountant to do it. There's a lot of disclosure. It's a pretty simple return, but there's a lot of disclosures on it. And you're in the tax system. Now, some people will say, listen, I'll have a U.S. trading account, but I'm just not going to get any dividends. I'm going to avoid dividends. I'm going to not have the interest income that has withholding, and I'm not going to trade MLPs. Now, there's more rules. You can't be in the U.S. for more than 183 days, or special rules for students. I cover all that in the guide and on our blog posts. There's a lot more details in the guide. This is just kind of the overview. So you really want to make sure that you can trade the U.S. markets without a tax bite. Now, let's say that you're living in America, but your brother lives in Germany or in China or in India. Maybe you're going to set up a company. This gets us into the next point. Foreign partners in U.S. trading partnerships can be tax-free. If the non-resident is a member of a U.S.-based pass-through taxable entity, such as a hedge fund. Now, usually foreigners go into offshore hedge funds, not U.S. funds. They don't want to land themselves in the U.S., but if you have a family trading company, one brother's in India, one brother's in the U.S., or in Europe or Asia, or in any event, let me start again here. If the non-resident member, if the non-resident is a member of a U.S.-based pass-through trading entity, such as a hedge fund or a proprietary trading firm or a family trading company, that person is still exempt from effectively connected income. Typically, foreign partners in U.S. partnerships are considered to have U.S. effectively connected income on their Schedule K-1s. That's their schedule that they get for their slice of the pie, their share of the gain or loss in the entity. But if the partnership is a trading company in financial markets, not goods, the income is considered portfolio income, including the partner share. So what I'm getting at is as follows. The two brothers, one in California, one in Europe, they set up a Delaware LLC filing a partnership return. The brother in Germany has 50%. Brother in California, 50%. K1 allocates 50% to the brother in Germany. There's no withholding, and it's not U.S. source income for the brother in Germany, and the brother in Germany doesn't have to file a U.S. return. Meanwhile, the U.S. partnership files a tax return for all the income and shows the two K1s, one to the U.S. brother, one to the German brother. Now, the German brothers, now the question comes up, hey, I don't have a brother in California. I want to just set up my own entity in Delaware, like a single member LLC, and open an account with a U.S. broker, because the broker doesn't want to deal with me as an individual. How can I do it? There is a very detailed way to do it, and I'm not going to just tell you that right here, right now. That's in the guide, and people consult with me about it, and there are obstacles to it with banking and more. So get the guide where it explains that more. Tom, I think we did pretty good on the 45 minutes. We went a little longer. I don't see many other questions on the board in chat. Maybe I have to refresh that. Did you see any other good questions?
Yeah, just one. Shakri purchased the guide in October of last year. Has anything changed much for 2016? I think you're on mute.
Sorry, I hit mute by accident, guys. Yes, a lot has changed. The strategy I just mentioned about the foreign partners and setting up a company in the U.S. as a non-resident alien, that's all in the new guide. I did send out a coupon code for people who bought the 015 guide to get an additional 20% off. So, I mean, they get a total of 40% off, and that also ends soon. So, look, Shakri, just contact customer support if you don't see that email to get that coupon code. But definitely get the new guide. There's a lot new. So I think we went through a lot, Tom. It was great to meet all your traders. Any last questions, Tom?
Oh, is there anything that our community should be thinking about this early in the tax year for planning purposes to get ready for their taxes the next time they file?
Well, it's tax filing season for 2015 tax returns now, so they're going to start getting 1099s from U.S. brokers, and they should not import those 1099s to TurboTax because that's importing broker wash sale calculations, which is the problem because the rules for taxpayers are much different. They need software like our trade log software, so go to our accounting service page, consider our help to do that trade log accounting for you with our professional license, or you can get a retail license yourself. I encourage you to sign up for our tax compliance service. That's our core business. We work with traders no matter where you are around the world. We can handle your tax matters. So it's a good time to get signed up with us and get started on the process. And then read our planning page as far as planning for the year ahead. And then if you have trader tax status, an entity could be a good idea for you. If you're a non-resident alien, the broker may require you to have an entity, so consider our entity formation service. Start with a consultation first. So go to the Trader Tax Center, get the guide, start with a consultation with me, then maybe do our compliance, or you can start with compliance right away. Learn more about us in the About Us area, and then do a chat with us, or just give us a call, or send us a web form email with your questions.
If somebody was going to use you to prepare their taxes, how much lead time should they plan on for you guys to actually, from start to finish to prepare it?
Probably a month.
A month,
because
okay.
It takes time to get set up, to get your stuff in order, to get it to us. Then we send back open items. Then you send back the answers. Then there's still open items. And then there's back and forth, review the draft. Some super organized clients can do it faster. But it's important to get started with us soon and to get us your information soon. Now, 1099Bs are modified. They come late. K1s come late. So a lot of clients have to file extensions, but you have to pay 90% of what you owe. So you still have to be super organized with us even to have an extension. And then you try to file in the summertime. So you can go to the tax compliance page and you can request a free 15-minute session with my partner, Darren Neuschwander, to get an estimate of price on your file. You'll upload your prior year return, and it's a good way to get to know and start working with us so we can tell you how long it will take, how much it will cost, what's involved. And that's a good way to see what's going to be the case for you before you sign up.
And looks like we had another question from James.
Yeah. Okay, I assume if all my trading is done in retirement accounts, I don't need to worry. Well, if you trade in retirement accounts like IRAs and you also have a taxable account, you can have a wash sale that's permanently lost. But if you only trade in retirement accounts, you don't have to worry about trader tax status. You don't have to worry about reporting. And if you lose money, in a sense, you're getting the benefit because it's just less money in your retirement account to take out in retirement. If you lose money in a Roth, that's unfortunate because you'll never get that benefit. If you go to our blog about losses, you'll see we talk a lot about that, and we talk a lot about retirement accounts in the guide. I'm not going to get into that last question. Rich, how are you? Let's see, TD. Let's see. Does anyone know if health savings account brokers will let us trade? I don't know about that. TD Ameritrade, HSA Bank will only let us do covered calls. That could be a little confusing to the IRS. But, of course, health savings accounts is you might save some money if you haven't spent it yet. I don't know that answer. That's not so much tax, Rich. Our tax compliance team probably would have more experience with that. So, Tom, I want to thank you and your membership for inviting me today to do this presentation. We're looking forward to working with you all and doing business and helping you out, and hopefully you'll get the guide as well. So,
And I'll in the replay just remind everyone that special price expires on the 15th, so they only have 2 days to take advantage of that.
good. And again, they just on the home page there, which is where people should come, Tom. They just, you can see right here on the right. First of all, there's a banner, and right here on the right side, Trader Tax Guide. It's right there.
Yep, I'll put the link right in there.
Oh, that's good. So thank you, everyone. I enjoyed it. And Tom, let's speak after you take me off live.
Okay.
Thank you, everyone.
All right, I'll give you a call, Bob.
Okay. Thanks.
All right,
Bye now.
Bye-bye.